Finally, guys, shares. First point I'd like to make, when you own a share in a company, you actually own a small piece of that company. A lot of people they look at that comparison between property and shares, and yes, property is fantastic because you can buy a piece of dirt or an apartment and you can go and feel it, touch it, feel good about it. Shares, you think you just own a piece of paper. It's not the case. Many of you out there are business owners. You know what it's like to own a business of your own. Essentially, when you're buying a share, you're buying a small piece of BHP, Woolies or ANZ. Shares are a long-term investment, 5 years plus. If you're thinking about, you've done the savings and the budgeting as Simon's suggested, and you want to buy a house in 2 to 3 years and you think, oh, the share market's a pretty good place to accumulate some wealth, forget about it, you're gambling. If you had have invested at the top of the market in 2007, wanting to buy in 2009, you'd know what I'm talking about. Buy quality. For every person that you speak to that quadrupled their money in the gold mine in the far north of Queensland, there's 15 to 20 stories of people that have done their dough. History has shown us that if you stick to blue chip types of companies, that the returns are there, and particularly in this market, some would suggest that some of those good quality companies have been oversold. We really advocate looking for companies that pay good, solid dividends, particularly in this environment. The market's volatile, and yes, the value of your investments may have fallen, but if you bought a good company that pays strong, reliable dividends, cash flow has remained reliable and consistent throughout, and you can use that money over time as it accumulates to perhaps pay off a chunk of your home loan, fund a portion of your kids' school fees, or if you don't have a need for it, an immediate need for it, you could look to reinvest that market in some of those good quality assets that I just alluded to. I really strongly suggest you ignore the volatility. One of the pitfalls of share investing is that, yeah, you can value a share every second and every day and it can do your head in. You need to commit and understand that when you buy a company or you buy a share, you buy it for the long term. It's that Warren Buffett style of investing. He knows something. He's the richest man in the world. You buy a company for life, effectively. Or, as he otherwise puts it, if the market was to shut down for 10 years and you own a company, you need to be comfortable that you're going to own that company for the next 10 years. A couple of examples, I guess, just to show you the power of some share market investing. Over a 10-year period, we start with an opening balance of $20,000. We've saved up some money by some good budgeting. We're able to save some money of $15,000 a year, so we put that into the share market. We've got a gross return of that 12%, which we talked about earlier. Over a 10-year period, you could look to accumulate close to $300,000. Now, the other thing I want to point out is you might think to yourself, well, what happens when share markets fall heavily? How does that affect that 12% return? What you tend to find is that when a share falls, or the share market falls significantly, 1 or 2 years, it is usually followed by a significant uptick in the market as well, sometimes 30 or 40%. So at the end of the day, that 12% return over a long period is definitely achievable. A lot of people talk to us about gearing. So what would happen if I look to borrow some money? So again, you've saved, you've budgeted, you've got a home, but you've managed to pay a lot of that home loan down. So you now have some equity in your property. The bank will allow you, in most circumstances, to redraw. So you can re-borrow from the property, the security you've got in your property. The loan interest is tax deductible on that money. You might look to say, okay, let's say I was able to borrow $50,000 at a rate of 7.5% being the long-term average. Again, the same parameters apply. Over a 10-year period, you could look to accumulate an additional $30,000 to $40,000 by putting that initial amount of $50,000. Now that $30,000 to $40,000 is after you've repaid that 50 grand. So a lot of people might sit there and go, well, I mean, it's a pretty good return over 10 years. It's not fantastic, but of course, all of these returns, I guess they're magnified depending on how much you're capable of borrowing. You might look to say over 5 years you've continued to save more money, repaid the home loan. You might look to borrow an additional amount. Of course, there are risks with gearing. You need to be aware of that. Just like returns can be magnified in a positive nature, they can also be magnified to the negative. So again, it comes back to that long-term focus. You need to make sure that you have no plans to repay that loan, or have to repay that loan in a short period of time, because If the market's gone against you, then obviously that's not the desired result. But it can, the power of leverage can obviously impact you greatly in terms of your wealth accumulation. Obviously, we didn't go into it tonight, but gearing works into property and to other assets that accumulate over time. So guys, that's our 8 topics. We've hit it in about 27 minutes. It's not too bad.